Your money is secretly disappearing and the government is doing it on purpose. No, seriously. They've got a hidden plan to fix a massive problem, and it's going to change everything about how you save and invest. I'm going to tell you exactly how they're doing it, who gets hurt, who makes out like a bandit, and most importantly, what you absolutely must do right now to protect your wealth. Stick around because the full scoop on how to survive this is coming at the very end. Governments around the world are drowning in mountains of debt. They need someone, anyone, to buy their endless IOUs. Usually, they have two terrible choices: either print tons of money and cause crazy inflation, or just flat out refuse to pay their debts. Both options blow up in their faces. But there's a third way, a secret weapon they're pulling out. It's called financial repression. At its core, financial repression is a toolkit of sneaky government policies. They use it to manage public debt without having to do politically suicidal things like massive tax hikes or huge spending cuts. Instead, they use more subtle tricks. They force borrowing costs down, even lower than the rate of inflation. This means the real value of what they owe actually shrinks over time. But here's the kicker: the real value of your savings quietly shrinks too. You barely even notice it happening. It's more than just keeping rates low. This is a full-blown system. They force big players like banks, insurance companies, and even your pension funds to buy and hold government bonds. Even when those bonds offer returns that can't keep up with rising prices, they create a captive market for their own debt. And it doesn't stop there. They also put up barriers to stop your money from leaving the country, making it hard for investors and companies to send their cash abroad looking for better returns. They want to trap your money here. This isn't new. It's a playbook as old as modern finance itself. After World War II, the United States, for example, slashed its massive debt from over 100% of the entire economy down to under 25% by the early 1970s. How? Not through painful defaults or rapid growth. It's because your grandparents' savings and pensions lost purchasing power as the government slowly paid down its debt with money that was worth less and less each year. They didn't even realize their money was slowly disappearing. So, why is this happening now? Well, after the 2008 financial meltdown and the recent global chaos, government borrowing has exploded across the developed world. They are desperate for a solution that avoids inflicting pain directly on voters. Here's the big shift. For decades, central banks were the main characters in the global markets, raising or lowering rates to guide the economy. But now, with government debt loads at staggering new heights, the responsibility has shifted. The government's budget and spending, what we call fiscal policy, now holds the real power. Central banks are increasingly forced to follow the lead of politicians. They call this fiscal dominance. This shift is huge because today's governments are totally reliant on continuous deficit spending. They need to support aging populations, maintain social programs, fund defense, and try to keep economies growing. Making big spending cuts is politically impossible, so they will do almost anything to keep borrowing costs low and avoid the pain of making big cuts or raising your taxes. Financial repression becomes their favorite tool because it's politically survivable. How will this play out? Expect pressure on big institutional investors like pension funds, insurers, and banks to ramp up dramatically. We're already seeing it in places like Europe, where government debt is classified as risk-free, even if it isn't. Banks are being encouraged to load up on these government bonds. As the financial pressure grows, these rules could become even more explicit, turning private savings into state financing on an unprecedented scale. Look at Japan. It's like a crystal ball for us. For years, the Japanese government has relied on super low rates and a massive investor base right there at home to fund its huge debt. Now, with traditional buyers getting nervous, policymakers are making sure there's demand for government bonds, even if it means new rules or direct pressure to make domestic institutions and companies absorb more public debt. It's coming here too. And it doesn't stop with the financial sector. Expect a creeping return of capital controls. These are barriers that prevent your wealth from escaping to safer or higher yielding places abroad. This could mean outright limits on how much money you can move, tighter reporting rules, or even restrictions on alternative investments. It might seem impossible in today's globalized world, but history shows that desperate governments always find ways to trap money when the pressure mounts. Get this. Governments may not just allow inflation to drift higher. They could quietly target and sustain much higher rates, perhaps in the 4 to 6% range year after year after year. It's a strategic move designed to quietly shrink their debt burden without explicit pain. But trying to fine-tune inflation like that is super dangerous. Once people expect prices to keep going up, inflation can quickly get totally out of control, creating risks that spill over far beyond just the government's balance sheet. So as this machinery of financial repression grinds on, the question every investor should be asking is who comes out ahead and who gets left behind? One thing is clear. Financial repression fundamentally reshapes the investment landscape. It quietly punishes some assets while opening up rare opportunities for others. Let's start with the losers. The most at risk are traditional savers and anyone relying on fixed income strategies. In a repression regime, interest rates are deliberately held below inflation, sometimes for years. If you're holding cash, savings accounts, or classic government bonds, the numbers on your statement might look stable, but the real value of your money is steadily being eaten away. Savers and pensioners and anyone on a fixed income find their purchasing power shrinking. What used to be considered a risk-free asset becomes, in effect, a guaranteed way to lose money. For banks, insurers, and pension funds, the real pain isn't just being forced into buying government debt. Their entire business models come under sustained pressure as their returns erode and their ability to innovate or provide meaningful returns to clients shrinks. Instead of building wealth for their clients, they end up helping the government raise money, forced to follow rules that put government needs ahead of profit. This means that for clients, especially those relying on traditional wealth management, there's less room for optimism. The usual ways to grow your money just don't work as well anymore. And what about stocks? Most people just buy the S&P 500 index. Here's a serious warning. When financial repression reaches its tipping point and asset managers are forced to reallocate into government bonds, broad selling could hit the biggest, most liquid stocks the hardest. This creates an environment where being passive, just buying the index and waiting, could really backfire. Passivity is now super risky. But there's not all doom and gloom. There's also could be clear winners. Hard assets like gold, commodities, and real estate have traditionally offered strong protection in eras of financial repression. These assets can keep pace with or even outstrip inflation. During the great liquidation of post-war debt, gold prices exploded as trust in regular currencies started to fade. Commodities and property offered not just a store of value, but a way to hedge against the relentless erosion caused by negative real interest rates. Also, look at select stocks as potential beneficiaries, specifically companies positioned in sectors that align with government fiscal priorities. So think infrastructure, defense, and energy. These industries often see public investment ramp up during periods of high government spending, while other parts of the market stagnate or shrink. And here's where things get truly interesting. In the modern era, crypto and stablecoins add a whole new chapter to this playbook. Stablecoins, for example, are often backed by government debt, the very assets that governments want everyone to own. So buying them has the effect of quietly subsidizing government borrowing. As government bonds become more tightly controlled, stablecoins like USDC could become increasingly important tools for both governments and the financial system. If interest rates remain high, but governments need to suppress borrowing costs, then stablecoins may be leaned on as quiet demand for government debt. But what about other cryptocurrencies? In this environment, the biggest beneficiaries are likely to be those that offer genuine decentralization, like Bitcoin and Ethereum, since they operate beyond the reach of traditional financial controls. When trust in banks, central banks, or even government bonds begins to erode, these digital assets can become alternative stores of value, potential lifeboats in a world of financial repression. We've already seen signs of this with Bitcoin actually rising during the banking turmoil last year. So, if financial repression is such a tough break for savers and market participants, then what alternatives do governments actually have? Well, there are a handful of classic ways out of a debt crisis, but none are easy, and most are even less politically palatable than the slow burn of financial repression. The first option is fiscal consolidation, what most of us know as austerity. This means governments slashing spending, raising taxes, or indeed both, to try and bring deficits back under control. In theory, it's the most direct and honest path, but it turns out to be very unpopular at the ballot box. With aging populations demanding more from public programs and political polarization at record highs, few leaders are willing to risk their careers pushing through deep spending cuts or tax hikes, which is why it's pretty much off the table in almost every major economy. The second path is debt restructuring or outright default. Now, this is the nuclear option for governments, admitting they simply can't pay what they owe and negotiating new terms or simply walking away. History shows that while defaults are not unheard of, they come with severe consequences, namely plunging credit ratings, capital fleeing the country, and often social unrest. For advanced economies, default remains the last resort, one that governments will delay at almost any cost as long as financial repression can buy them time. Then there's the market-friendly option, economic liberalization and growth-oriented reform. History shows that when governments open up markets, cut red tape, and foster innovation, growth can help whittle down debt without painful sacrifices. But today's political environment is not exactly right for big sweeping reforms. There's not much interest in loosening the rules, and powerful groups often stand in the way of big changes. So, a fourth option is international coordination. In an ideal world, major economies could agree to coordinate their money and spending policies, smoothing out the global shocks that make financial repression so tempting. But given today's political tensions, fragmentation, and rising nationalism, real effective coordination is likely not on the horizon. Instead, what we're seeing is more divergence, not less, making each country's path even more dependent on domestic politics. The truth is, while other paths exist, none are as quietly effective or as politically survivable as financial repression. It's the path of least resistance, the one that hides the cost and spreads the pain so thinly over time that few even notice it's happening. So, then, given everything we've covered, what can you actually do to protect and position yourself in this new era of financial repression? First, understand the market won't just have a dramatic, sudden crash like in 2008. Not initially. Instead, expect a market melt up. In the early phases, tons of liquidity and negative real yields will push asset prices higher, stocks, property, and even crypto, as investors scramble to outrun inflation and government debt suppression. Each dip will be met with sharp rallies, creating the illusion of unstoppable momentum. But eventually, as regulatory mandates and political pressures build, the rules change. Asset managers, especially the big institutions, will be forced to buy ever larger quantities of government bonds. This means they'll need to sell off equities and other risky assets to make room. This sets up a drawn-out period of forced rotation in which capital is steadily siphoned out of the private sector and absorbed by the state. The result won't be a sudden market crash, but a slow, grinding decline in asset prices. A bear market engineered not by panic, but by regulatory design. So this dynamic makes being passive more dangerous than ever before. For traditional investors, the lesson is simple. Don't underestimate the impact of inflation on your wealth. Sticking with cash or bonds that pay less than inflation is a recipe for quietly losing purchasing power. As I mentioned before, this is an environment that calls for moving away from major stock market index funds and bonds and towards hard assets like gold, commodities, and real estate. Also, look at select value or infrastructure stocks. Diversification is also critical. By spreading assets across different countries and markets, you lower the risk of being trapped by any single government's policies. History has shown that rules can change overnight, and jurisdictions that once seemed safe may not remain so. For the crypto investors among us, the stakes are equally high, but play out on different fronts. Financial repression often triggers speculative surges in alternative assets as capital seeks refuge. We've already seen crypto act as a lifeboat during periods of macro stress. But the warnings about regulatory pressures shouldn't be ignored. As governments fight to maintain control, expect more attempts to regulate, monitor, or even restrict crypto activity, especially around stablecoins. So prioritize self-custody and security for your digital assets and remain agile. Be ready for periods of sharp rallies as liquidity chases returns outside the mainstream, but don't be caught off guard by new rules or coordinated attempts to limit capital flows in and out of digital assets. Above all, the main lesson applies to both traditional and crypto investors. Don't trust that what worked yesterday will work tomorrow. Financial repression is a slow moving, ongoing change, not a one off. Those who are willing to diversify, stay alert to inflation, and embrace both hard assets and new financial instruments like crypto will be best positioned to protect and potentially grow their wealth as the landscape evolves. So, if there's one thing to take away, it's that being passive is now the greatest risk of all. Those who adapt early, who recognize the warning signs, will have a clear edge. In a world where stealth taxes are the new normal, being proactive is not just smart, it's essential for your financial survival. This is a massive shift, and ignoring it means risking your financial future. If this video helped you understand what's coming, hit that like button right now. Subscribe to the channel so you don't miss our next video on how globalism is changing the game. And make sure you ring that notification bell so you're always ahead of the curve. Thanks for watching, and I'll see you in the next one.